Good morning, everyone. I'm Gayleen Rogers Lonergan, and welcome to Legal Answers Just for Real Estate. I am so privileged to be joined today by Ann Christensen with Dumfries Investment Properties and Hardthorn Capital LLC. Ann has been in the real estate business for over 20 years. And today, I think she's going to share some of her expertise generally about real estate as well as specifically about owner finance. Welcome, Ann.
Thank you. Appreciate it. Thank you for letting me
Absolutely.
come.
We're so pleased to have you. So just to start off, why don't you tell us a little bit more about your background and how you got into real estate investing initially?
Well, I kind of stumbled into it initially because of the market conditions. I was in the military moving around, and I only actually started doing rentals about 20 years ago when I was unable to sell a house when I moved. So I ended up instead, because the market was down, I turned it into a rental. So I kind of stumbled into it initially, but I didn't fully appreciate the value of what real estate can bring in building one's portfolio and that long-term wealth
Well,
that it can
yes.
grow.
Yes, absolutely.
So I didn't have, it's the standard saying is, if I only knew then what I know now,
Right.
I would have had a much larger portfolio when I retired, rather than the smaller one that I have. So after I retired, I did have a few rentals. And then I ended up wanting to do something after retirement from the military to supplement my income, but I wanted to be able to have more flexibility on my time. So I ended up I wanted to do something more part-time and
Yes.
not just another full-time job.
Right.
So what we all kind of go for,
Right.
transitioning down the time. So that's when I started getting into flipping because I knew control more time. And that I did that for several years. And I didn't realize what owner financing was. And that was kind of why at the time I was mainly focused on flipping. But
Right.
now I'm changing that focus more to where my primary focus is owner finance and private lending, mainly like for the gap type of lending for investors.
Yes, absolutely. Absolutely. Yeah. Like you said, if only we knew then what we know now, we'd all be better off, wouldn't
Yes.
we? Why transition a business into owner finance?
Well, like many flippers, I was initially first looking at just the money you make today with flipping a house. And I didn't fully appreciate the benefit of that reoccurring long-term positive
Mhm.
cash flow. And it ultimately ends up resulting in a significantly higher profit when you're looking at owner finance. And like I kind of mentioned before, I didn't know about this niche of the market at all. Because all you ever typically hear about is flipping and rentals.
That's right.
And so that's what I focused on.
Absolutely. And most real estate agents don't have any much knowledge of owner finance either. So it's not that people ever really get introduced to it unless they are lucky enough to run into people that have the knowledge to do it and are willing to share it.
Right. And so when I actually started digging in and researching owner finance, and then I started running the numbers, that's when it became a no-brainer. It was because the numbers would speak to me.
Right.
I mean, as an example, I recently flipped a house and everything that could go wrong did go wrong. I had termites. I ended up being behind the walls. I thought it was gonna be a light rehab. But then when you start having termites into major structural, I ended up with the sewer went out, and then the market shifted when it turned around to sell. So what I started out was gonna make a good profit on a flip. I was only gonna make about 6,000 at the end of
For
that,
all of your work.
for all of the work after 6 months of a lot of struggling. Instead, when I started running the numbers with owner finance, I pivoted. And instead of only making 6,000 in when I initially sell it, within 1 year, if I turn it to owner finance, I'm gonna end up making 11,000 in the first year, 26,000 by the third year, and by the fifth year, 78,000 if I hold it.
Wow.
Depending on how long they hold it and they refi it.
Well, those numbers should talk to just about anybody.
Absolutely. And then even if I look from the rental perspective, from a rental perspective, I was looking at probably cash flowing about $206 a month. And that's after you look at CapEx and maintenance and vacancies
Right.
and everything that you have to pay for on a rental to hold it. Whereas my monthly payments on owner finance is $1,000.
Fantastic, fantastic. And
And-
there's no fixing the toilet in the middle of the
No.
night or anything like that,
There
right?
a lot fewer unknowns. So this is where it said the numbers is, it became a no-brainer. But you've got to be able to run that analysis. And so I actually ended up creating a calculator to do that analysis. And it actually ends up puts in 56 different cost factors to put a side-by-side comparison for rental, for flipping, or for owner finance, but not just for today, but for the long term.
Oh, wow, that's fantastic.
And so that's what I use extensively whenever I'm doing deals to figure out what is the best avenue for it. If I'm looking to flip it, or as I said, my priority right now is pushing everything to owner finance because I'm wanting that long-term cash flow.
Right,
Financial freedom is something that we're all looking for,
right.
where your income ultimately ends up paying for all of your expenses. And as we get closer to retirement,
Do not know.
we don't want to admit it, but it's coming.
Right,
Is that we want that income to be passive. So that it's not
Correct.
the active income that we're looking at, because gone are the days of having pension.
right.
So we have to create that mechanism to provide that continuous income into retirement, or even for our heirs, if we're focusing more onto that generational wealth. Flipping is a good source of revenue, but it's one and done.
Yeah, and it's a lot of work.
It is a lot of work. And once you sell it, you're starting all over again.
Right,
With finding the deal, finding the contractors, managing it. We have to ultimately transition that to a buy and hold type asset scenario for our portfolios. And that's where I'm at with focusing on my portfolio as I'm looking to build my wealth. And that can be done either with rentals or with notes. But the key is you got to pay off that debt to get that cash flow. But anybody who's been a landlord and they say that's passive income, it's not. It's only passive when the house is occupied and nothing breaks. Because renters,
right.
they change out about every 24 months. So you're constantly having to turn over the house. You're constantly dealing with repairs. The last 2 months I've been I got a wall oven replaced. Well, within a month it broke.
Oh, my.
So now I'm dealing even worse with the warranty company.
Oh, my.
So it takes up a lot of time. And then taxes and insurance, particularly here in Texas, has been going up. So that's eroding any type of cash flow we may have been getting in the past with our rentals. And with rentals, it's most of your equity is actually tied up in the property itself. So
Yes,
the only way that you get access to it is by having to either refi it or sell it.
right.
So again, it just takes a significant amount of work with rentals. Whereas on my notes, the work, I go in, log into my Bank America account and see if the deposit's there.
Right,
That's the work.
exactly.
Monthly payments, 3 to 4 times that of what rent would be. And also the tax burden, I can spread now over time instead of getting hit with a capital gain on that principal. And if I need cash, you're not locked into it. You can still, if you've made a good note, sell that note on the secondary market if life happens and you need access to that cash. So that's where, for those people who may not be familiar with what owner finance is, just at a very simplistic level, that's basically where the seller allows the buyer to make payments over time to purchase the property instead of all at once at the very beginning. You become the bank.
Correct, right.
And we know banks are in business to make money. So obviously that's a good scenario.
It's a good scenario, right.
So, you can either do this if you own the property outright, or you can do it if you have an underlying loan. And that's the majority of my owner finances I do with what we call wrap notes. So you have your underlying lien, you take your larger note to the end buyer and wrap that around that first note. And then that second note to the end buyer typically has a higher interest rate and a higher principal amount. That end buyer will then make the payments to me or through a servicer that will pay that underlying loan. They end up escrowing all the taxes and insurance, so that they're paying that. And then I cash flow the principal and interest difference. And so it makes for a very profitable scenario.
Absolutely, absolutely. Wrap financing can be very lucrative. Absolutely. Okay, so what type of buyers would be looking for owner finance?
So typically you're looking at people who, they can have a lot of situations going on. A lot of them tend to be self-employed, people who own their own business. We all want to deduct or write off as much as possible in April, whenever it comes time to tax season, to reduce that tax bill. Well, that has a third order effect when it comes to trying to get a loan, because now you're decreasing your revenue on your taxes.
Right,
So it makes it a lot harder. You know this because you own a
absolutely,
business.
yes, for the last 25 years, absolutely. I'm exactly that way.
Absolutely. So as a lender, we control the underwriting and we can be more flexible. So if a person has been doing that on the taxes, we're not bound to just look at the tax returns. We can look at bank statements and see what they're actually pulling in with their business.
Right.
We can also accept a higher debt to income ratio. We
Mhm.
got to be careful with that, but we can go higher than what the banks have. There are also people out there who they want to they don't want to be running credit cards and debt. It's within their culture. They want to deal more in cash. So they
Yes.
may have a very limited credit.
Right,
So we can use alternate payment history to compensate for that lack of credit. 'Cause
right,
we can be more flexible because we're dealing one-on-one with that buyer. Whereas the banks, they're looking square peg, square hole.
right.
And if you don't fit their scenario, you're out, or you're paying more points, or you're paying more fees, or a higher interest rate.
Absolutely, yeah, though, the frontline loan officers, they don't have the flexibility
No,
that, owners of the property do,
no.
without question.
So, also, another, people who perhaps don't have seasoned funds, if they've recently changed their job, or another large market, or is the I-10 market. Because they're
Yes.
limited. Only specialized banks will end up giving them loans. So, the market is definitely out there. Back in the early 2000s, if you fogged a mirror, you could get a loan.
That is so true.
Remember that?
Yes, I do.
And then came the subprime crash right after that.
Right,
And so then the government came in and they brought in much more stricter rules and regulations.
right,
Excuse me. So, but unfortunately, on top of that, since then, the banks have been getting more and more tighter with their regulations
yes,
or with what they're accepting for loans. And so basically almost 70% of the market can't qualify for your typical premium loan. So they're always having to pay a little bit higher interest, like I said, or fees or other points. So that gap between the rules and where the banks are today, that gap is where the opportunity is for owner finance.
oh, yeah, oh, absolutely, absolutely,
And it's not necessarily a small market either. In 2024, over 30 billion was purchased through owner finance last year
Oh, I had no
across the
idea.
nation. And, as the housing market dropped last year, because we all know we've had a
Right.
reduction, particularly when you look at across the nation, owner finance actually increased 8.4%. So that kind of shows you how much it is still a prevalent option, both for buyers and for sellers. And Texas makes up 25% of the market in the nation. So we're
Wow,
a huge
we're
focus.
huge, yeah, absolutely. What a great opportunity there.
And the people doing them, it's not your hedge funds, it's not big, corporations or partnerships. It's people like you and me who's just
Yeah.
doing like 1, 2, maybe 3 a year. But even just so people who just do 1 a year, that made up 86% of that 30
Wow,
billion.
yeah, absolutely, yeah, mom and pops, this is a perfect,
It is.
perfect strategy.
It is.
Well, so I know from the legal side, but isn't this wrap owner finance in general, isn't that risky? Or what happens if they don't pay.
Well, as with any investment, there's always some level of risk. But there are ways to mitigate it. So that's the key. First and number one is doing your due diligence when you're qualifying that buyer, making sure they have the ability to repay the loan. And sorry, making sure, banks, their typical debt to income ratio is about 43%. Whereas on owner finance, I've gone as high as 55%.
Mhm.
If you go much higher than that, you could be getting into some shaky ground because, life happens. And if something changes
Right.
for that buyer, they may be struggling to make the payment. The second key is making sure they have skin in the game. And
Oh,
that's with that
absolutely.
down payment.
Mhm.
They've got to make sure that, if they have a solid down payment, they're less likely to walk when things happen. And then, and this is definitely in your bailiwick, making sure you secure that property with a deed of trust.
Oh, yes, absolutely. Oh, absolutely. Making sure you're documenting your loans
Yes,
properly and securing your collateral, because that is what is gonna save you if the worst thing happens and you have to foreclose.
absolutely, absolutely. And then the last thing I would say would be, staying engaged with your
Oh,
loan,
yeah.
monitoring the payments, following up immediately if they miss one. Don't wait 2 or 3 months. You've got to follow up immediately and have a plan and resources should you have to go the worst case route into foreclosure.
Right, absolutely. Yeah, that having that down payment to help mitigate any loss you might have as far as foreclosure is key.
Absolutely.
Right. Well, isn't it complicated with all the rules?
Well, I must admit, when I first started getting into this, excuse me, when I first started getting into this, I definitely thought all those laws and such were pretty daunting. And there's, you have all the disclosures and they're always adding each year, they seem to be adding more disclosures
Yes.
that you have to provide those borrowers and there's a specific timeline they have to have. But, we're the bank, so these are similar things, for all lending. But there's a de minimis rule. So a lot of those rules don't necessarily pertain to you if you're only doing 1, 2, or 3 a year. But there are some critical ones that apply to everybody across the board. And it's not just federal laws, it's also state rules. So you've got to make sure that you're staying on top of that type of stuff. The most common that people hear about is the Dodd-Frank.
Right.
We always hear about that probably the most with a lot of the, anything that you ever see on the internet. And that's basically just the rule that was put in place to make sure that we ensure that the buyer has a reasonable ability to repay the loan.
Right. And that's just common sense, isn't it?
Exactly. If we're wanting a win-win situation with our buyer, because we want a successful investment, you wouldn't think you'd have to put it in a law, but unfortunately you did, because these laws were put in place mainly because there was a lot of bad actors out there
Right.
that were taking advantage of people. So I actually am not against these rules because, like I said, I want a successful investment, so I want it good for the buyer and for myself. You also have the SAFE, the RESPA, the TILA, the TSEC. You're familiar with all these.
Yeah.
I mean, the acronyms go on and on. I feel like I'm back in the
Right.
military. So
That's another reason why, if you're gonna do this owner financing, you need to have guidance from someone that knows about all of those
absolutely.
rules and regulations. Don't try to just fire off and do it on your own with a form printed from Office Depot.
Yes, absolutely. I mean, yeah, you can Google anything, and now with Chat GPT, they can create anything. But the thing is, the rules are specific to the situation, they're specific to the state.
Right.
So there's a lot of specific language you have to have in those key documents. And if you don't have it right, then that can make it very difficult if you have to go to court to defend your investment.
Right. So it's really false economy to not spend some money to make sure
Absolutely.
that it's being done correctly.
What's the old saying? Pay now, pay later?
That's right. And pay later. I have so many clients that have paid me a lot more later.
A lot later. Absolutely. As with anything new, you have to do some level of education, but it's manageable. as I mentioned before, the rules are out there to eliminate bad actors. So if you're gonna do the right thing, then it's really not anything to be concerned about. You recently had Joe Boston on one of your
Yes,
podcasts
yes.
from Dallas Real Estate Investment Group. And he provides a lot of training for investors for doing new construction and fix and flip. And I actually lead his owner finance circle. And so a lot of our group members have been asking, because we've been showing them the numbers and how profitable this investing is. So come by popular demand, we're basically I believe we've just about finalized our training program.
Oh,
So
fantastic.
next month, we're looking at launching, and it would look like a 1 day, it'd be a full day basically of an intense owner finance class that we're going to provide through Dallas REIG.
Oh, fantastic. I will be looking forward to hearing more about that for sure.
Absolutely. And with that, it will provide the people everything they need, step by step through the process, the disclosures they got to have, how to qualify buyers to make sure that their investment is safe. And we'll provide them with toolkit. So they'll have checklists, they'll have sample
Oh,
letters.
great.
And like I mentioned before, I use an application to pre-qual to help weed out people who aren't going to qualify. So all that stuff will be in the toolkit for them. So they'll basically have everything they need to do
Oh,
their first
great.
deal.
Yeah, I can't wait to hear more about it. And well, so tell me this has been fascinating, but tell me what you have as far as some tips or mistakes that you think people need to know to avoid with owner finance.
Well, like with any financial instrument, the owner finance note is only as good as it's structured. So our goal is to create a note that protects the position, keeps the buyer committed, and produces a reliable, predictable income. So to do that, one of the things that I find that's probably the biggest thing a mistake a person can make is having a low down payment. I kind of mentioned before,
Yes,
they got to have skin in the game. That down payment is your first line of defense against a default. Having a strong down payment, they're less likely to be to walk away from it because they're financially committed. And you mentioned that if should you have to, and I said this a point of last resort foreclose, you at least have some cushion and the funds to be able to take that property back. So typically, you in this market, you're looking at a 10 to 20% typically for down payment.
yes,
A second item would be setting poor balanced terms. What I mean by that is, your interest rate and your terms need to be competitive. If you have too high an interest rate, they will be quick to refi, and you're just going to cut out your long-term earnings.
right.
If it's too low, you're leaving money on the table, and inflation is going to eat away at your returns. So typically what I see is about a 10%, but a lot depends on the circumstances and what those current rates are.
Right.
But that's typically kind of the margin that we see. And then for the term period, you're typically looking at 20 to 30 years. And you generally don't want to go beyond 30 years, not on an owner occupied property. A third item would be neglecting the buyer screening.
Oh, yes,
You are the bank. So you need to underwrite like a lender. Checking the credit history, the income verification, job stability, checking those things will basically highlight what typically are going to be red flags and lead to problems down the road. So, and the other thing would be making sure you get the documentation. We're not in this for self-certification where people just, oh, I'm going to fill in an application. I'm going to tell you what everything is.
right.
What's the old adage? Trust but verify.
Right.
You've got to make sure that the documents support it. I typically, I mentioned before, pre-qualify buyers, and I have specific questions that I end up putting in that I know that tend to kind of hook people when we go to qualify them, that could create a problem. So when they do that, and I also do a soft credit check. So it doesn't hit their credit line, but I can then verify what they put on their application to make sure that everything works out. And it basically weeds out those qualifying buyers.
Absolutely. And let me just throw in one. Oh, go ahead. Go ahead.
No, I just want to say, I'm gonna move on to the team.
Yeah,
So
the
my,
team.
my last
Yeah,
item, so my
absolutely.
last tip is the team. And that's, you want to make sure you have an RMLO
Yes.
to help you do your underwriting. You want to make sure you have a real estate attorney and title company who is experienced in non-traditional. That is critical. There's a lot of them out there, but they may not be experienced in non-traditional. Because as we said, you got to make sure you got the right provisions so that you have the strong language to protect your asset. And the title company will make sure that the deed gets recorded. And then the last partner is a servicer. They collect the payments, they escrow they'll calculate your escrows, they pay the taxes and insurance, they'll pay the underlying mortgage, they handle everything for you, and they'll handle all the tax requirements, making sure that the IRS, the buyer, and you get all the required documents to keep your loan sound. That's what makes owner financing truly passive.
Oh, I got you. I agree with all of that. And, in fact, I almost on a wrap owner finance, unless there's a servicer, I sometimes just pass on doing it. Because it's so critical to have that interim party
Yeah.
to handle everything. And they do all the reporting, annual reporting to your buyers. And
Mhm.
it's just, and it's not expensive at all, but
And the buyer
very
pays
critical.
for it.
The buyer pays for it. And this has been great. I have been closing owner finance transactions the whole 25 years that I've been here in business.
You've done
And-
all mine.
And I've done all of yours, and I've learned a lot over 25 years, but things are always changing. So that's why it's really critical to have a knowledgeable attorney and title company on these transactions. I agree with you 100%. So, just to wrap up, this has been so useful. And for more information, there will be a link on the podcast. A QR code will be on the screen. You just go to that. And this is, just so you all will know, this is the first, we're going to be doing a series regarding different aspects of owner finance for the next few months, because like Ann, I think it's a strategy that everyone should know and utilize if at all possible. I think on our next podcast, we're going to talk about some insurance aspects of owner finance, which is different than your retail
Yes.
insurance agent insuring the property. So that will be next time. And with that, I want to thank Ann for being with us. And we will see you guys next time.